From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, Fed divergence. It calls for one cut this year as markets and other central banks are more dovish. And U.S. yields are driven lower as inflation data and consumer sentiment starts to cool. And U.S. junk bonds head toward the strongest weekly return in 6 weeks as investors bet on more cuts. But we begin with the big issue, deciphering the Fed's message.
The theme is still patience.
I think it's staying the course. I think it's caution. This is a Fed that's going to remain data dependent. There's no clear indication that they're going to need to rush into cuts.
If you look at the comprehensive look at the economy, it's still relatively strong.
Just like they didn't overreact to the stronger inflation data in the beginning of the year, they're not going to overreact to the weaker inflation data.
Having been a little bit burned by the enthusiasm at the end of last year and then the reversal on inflation, they're not going to want to reverse so quickly with just one good print.
There will be cuts by the U.S. Federal Reserve at some point in the second half of the year.
They'll start cutting sometime in the first quarter of next year, and then deliver a steady set of cuts for the remainder of the year.
There's a higher probability that the Fed cuts more aggressively at some point in the future than this really sanguine view the market has.
They're trying to tell us that they're keeping all optionality open.
This might have been the week that broke the camel's back, so to speak. If you looked at the CPI and PPI headline numbers, that is consumer and producer pricing, you saw progress here on both fronts. Of course, we saw that jump up in late 2021 into 2022 in producer prices. After that promising CPI report, you had a day later those producer prices also giving the market more steam to start to change their expectations, perhaps even ahead of the Fed, in terms of how many rate cuts could be seen this year. So finally, progress really baked into the market. If you flip up the board here and look at what that translates to, this is the WIRP function on the Bloomberg terminal for the pricing of Fed rate cuts. And remember, just a week or so ago, when we saw the jobs report and the strength still seeping into the economy, a lot of concerns about when that first rate cut would be. Not only now do you have more bets on rate cuts, of course, a lot of differences in the market between that July and September and even a November cut, but certainly a lot of certainty here that we might see at least 2 by the end of this year, despite what the Fed's dot plot says. Here's what Fed Chair Jay Powell had to say about it at this week's news conference.
We think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting.
Joining us now is Gennadiy Goldberg of TD Securities and Brian Rehling of Wells Fargo. And to the both of you, of course, we've seen such a huge round robin this week. Gennadiy, because you have such an interesting price target here for the end of the year, can you explain where you see rates headed toward the end of the year and put that into perspective from what we're expecting out of rate cuts this year?
Yeah, so we're still expecting 2 rate cuts this year, starting in September and December. We are looking for the 10-year to finish the year at 3.9%. And I know it sounds really, really low, but just look how far we've come this week. I mean, we've already moved basically 30 basis points on the 10-year just this week alone. A couple more weeks like this, a couple of week data prints, and we'll be right there. I don't think we're as far away as a lot of people think. And it's sort of a one-way market. I mean, you saw the remarks from Jay Powell. He basically lopped off the entire right-hand side distribution of interest rates. He basically said, we're not looking to hike. It's either hold or cut. And it's, you know, the markets are starting to move. It's
certainly some certainty. Brian, where do you see us at the end of the year for the 10-year?
You know, we have a little bit higher range. It would look more like 4.25, 4.5. I mean, we've basically been trading this year between, 380 and 470. So we're kind of in the middle there. We'll just have to see how the economy plays out. I just expect a lot more volatility here in the second half of the year than we've seen in the first half.
Well, let's talk through that volatility. Certainly, we have seen a lot of it so far this year already, and it's made it really hard for investors to find an entry point. Gennadiy, how do you figure out where that entry point is today?
Looking for extremes, to be entirely honest. I mean, certainly we're looking at towards the lower end of the range. We'll see what comes out of the next data point. I mean, if we're seeing a weakening in retail sales next week, we can actually see rates extend their move. If not, we kind of back up. But I think the range has shifted. We went from kind of an upward channel in rates to a downward channel at this point. So all of the momentum, and you saw the repricing of the market in the wake of the Fed, the market didn't take that one rate cut signal to actually price out cuts this year. They priced in, they're continuing to price in over 2 cuts this year, despite the kind of the warning from the Fed to be a little cautious.
Yeah, Brian, how do you figure out how this disconnect really plays out in the market? If you look at what the Fed is saying, there are plenty of officials who will very vocally come out and say that they're not ready to call victory on inflation just yet. How do you feel about the market's propensity to push that narrative forward and see those 2 rate cuts?
Well, I mean, let's not forget the market was looking for 6 or 7 rate cuts at the beginning of this year. So, the market sometimes trying to push around the Fed. I mean, there's just no urgency for the Fed here, right? Dual mandate, price stability. We're not down to their 2% inflation target. We're trending the right way, but we're still a bit away from that. And the employment market, while looking a little weaker, is still relatively close to full employment. So, and risk markets are up. So what's the urgency for the Fed? Now, if any of those factors change, if we saw a big sell-off in risk markets, we saw a bigger movement in inflation one way or the other, or we saw a bigger rollover in the jobs market, then the Fed may have to expedite things. But as it stands now, there's just no urgency for the Fed. Although, I mean, we do expect them to cut this year, but I think the Fed's sitting back and, they just have the ability to wait at this point.
It's interesting at the same time, while we're seeing kind of interest rates still stay higher at this point in time, no cuts today at the very least, or no cuts in the very near term. You do see that University of Michigan sentiment data, consumer sentiment falling to an unexpected 7-month low. Do you think that under the surface there are places, Gennadiy, that things are starting to weaken a little more than expected, despite what the jobs numbers say?
Yeah, absolutely. I mean, if you look at just the number of job openings and the pace of the decline in job openings, it's something Chair Powell continues to mention. Look at the pace of that decline just in the last 6 months. It has absolutely plummeted. I think some of the Fed, the FOMC members are starting to get a little bit concerned that this is starting to happen a little bit too quickly, and wondering, well, what if this happens to spill over into the broader economy? What if in the next few months we will continue to see data soften? So, we've still got 3 payroll reports, 3 CPI reports, 3 PCE reports, all ahead of the September meeting, not the July meeting. I think that's mostly a placeholder. But they will decide. I mean, I think they want to get started sooner than later, because the last thing they want to do is actually overdo it on tightening. And I think that they've been very consistent about that. They'll certainly keep rates on hold. They're not rushing. There's definitely no rush. But the next couple of data points can be pretty surprising for them, especially as inflation has actually come down dramatically.
Brian, when you look at any pockets of stress in the economy, if you think about whether it's lower-income consumers, for example, or pressures persistent in the real estate market as well, do you have concerns that there are parts of the economy that can turn hard enough that it would bring other parts down with it?
I mean, we've had concerns for some time. The surprising thing is that, the consumer, at least the high-end consumer, has just consistently showed up. And, maybe we're getting stretched. Maybe that will not continue. There's clearly stresses in especially the commercial real estate markets and other pockets of stress. As you can see in the consumer sentiment numbers, the perception out there, and probably what a lot of kind of middle to lower income consumers, they're really feeling it, but they've been feeling it for some time. It's just a matter of, seeing that spill over into the job markets. If people begin to be less confident about their jobs, if they start to see their home values, real estate values have held up okay for kind of households. If they start to see that fall over, they start to see their 401k go down, they'll likely get a lot more cautious. But until those things happen, the continuation of what we've seen over the first 6 months of this year, has the potential to continue.
It's interesting, Gennadiy. If you look at the forward calendar, next week is just riddled with Fed speak. There are a lot of people who are coming to the table. What will you be listening for?
Lots of divergence, I can tell you that much. I mean, there's going to be all sorts of opinions. You could see where the dots are. There's some folks calling for no cuts, one cut, or two cuts. But I think at the end of the day, they're going to be focused on inflation. So, we're talking a lot about things weakening on the labor market side or on the consumer side. It's really the fact that inflation has actually dramatically slowed, and it is going to continue to slow. We saw, insurance prices start to turn over. OER and rents really start to come down as well. The path forward for the next few months for inflation is actually quite positive. I think a lot of them are going to tell us if that continues, despite the fact that the economy is actually growing well, we can actually start rate cuts sooner than later. It doesn't have to be a fall off in growth. That would make us late.
Both of you, we thank you so much for your time. Happy Friday. Happy weekend to both of you. That is Gennadiy Goldberg and Brian Rehling. Now, up next, we're going to talk about the auction block because even with an issuance slowdown this week, Burberry is making a stylish return. Details up next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where the double dose of inflation data and the Fed put a sudden stop to that credit issuance surge we've seen all year, at least for 1 week. It was the slowest week of the year for high-grade U.S. sales, with just under $6 billion of new supply. Notable names included GM, Take-Two, and HPS. One sale that stood out in the UK was Burberry. It sold bonds for the first time since 2020 as it works to raise cash for a turnaround. It had a $300 million 6-year, or 300 million pound 6-year pound-denominated offering and received more than 990 pounds of orders. In sovereigns, both the 10-year and the 30-year Treasury reopening sales saw strong demand. The bid-to-cover ratio was the highest at a 10-year reopening since 2018. And Winnie Caesar of Credit Suisse sees this opportunity still brewing in credit.
There's the push and pull between the spread buyers and the yield buyers. The yield buyers are winning, right? Anytime you see a backup in yields, a little bit of widening in spreads, people get back in because they say, hey, investment grade at 5.5%, 6%. Historically, that's a home run. High yield at 8%, historically, that's a great bet. We're looking for a little bit of volatility on the credit side of things as the adjustment to expecting rates to be a little bit higher for a little bit longer hasn't really played through in those highly leveraged, lower rated capital structures in the broadly syndicated loan market as well. In the IG market, we still like taking credit risk. We're fine going down to double Bs, even in the high yield market. But duration here looks really attractive.
And joining us now is Andrea DiCenso, co-portfolio manager at Loomis Sayles, and Mike Best, high-yield portfolio manager at Barings. And what a week to talk about high yield in particular, because you're seeing people really put on more of that risk appetite after that expectation for rate cuts. The search for yields, Mike, how far does it go?
It's a great question. And I think with spreads being, certainly for double Bs and single B rated credit, are approaching all-time tights and in some cases through them. I think investors are looking at more than just a spread metric to sort of evaluate high yield. I think as maybe some of the previous comments had highlighted, duration is quite short in the high yield bond market relative to historical levels. Prices are at discounts, and so every time there's sort of any sort of backup in macroeconomic data or what have you, there's buyers that step in pretty easily. But there are stresses out there in the lower end of the market, and certainly want to be, cognizant of those. And, our general expectation is the triple Cs and some of the lower rated and lower distressed names in leveraged loan land will struggle to rally in this market just because fundamentals aren't going to support them really rallying.
Right. If you look at how much money has been pouring in, Andrea, do you think that the returns are really justifying what you're getting for the risk that you're taking on, especially where spreads have been lately?
No, I think he's hitting the nail on the head here. When you think about the backdrop that's really played towards those lower quality securities outperforming, it's been a low volatility backdrop. Now, that is still consistently the case across most asset classes, but where are we seeing vol pickup? the currency market, the rate market, as we've sort of shifted the narrative from concerns about inflation towards concerns about growth. And that certainly will disrupt the return profile of those lower quality tiers of the leveraged loan market as well as the high yield market.
Well, let's go into some of those riskier parts. I think leveraged loans, Andrea, is one of the more exciting parts of the market right now because you feel issuers just coming to market for all sorts of different reasons. You see the banks pushing it too, but are there buyers on the other end?
So far to date, there certainly have been buyers, but I think as we start to see perhaps more than one as the Fed, more than one cut as the Fed has put out in the marketplace as of this week, the market's already pricing in 2 cuts. Should we get more concerned about growth and start to see 3 cuts potentially priced in, I think you'll start to see investors move towards the door in that floating rate market for duration assets at that point.
Now, it's interesting, Mike, you alluded to troubles brewing under the surface in some areas. Where are you seeing those stresses starting to materialize, and where are you watching for more stresses to come to the surface in the future?
Yeah, I'll tackle the first one, which is where are we seeing them right now? Right now, we are generally speaking seeing stresses come up in less cyclical sectors than people are expecting. And the reason for that is in most cases, cable media, telecoms tends to be the really hot sector for distresses and default type scenarios right now. And what investors are seeing in those credits, fundamentally, they're not able to grow at a really fast clip right now. And by the way, as it's been alluded to, interest costs rising for them are really eroding free cash flow. So as they sort of tackle a changing media, a changing technology, and a changing cable backdrop, they're having a much harder time dealing with those stresses, and fundamentals are deteriorating there.
Where do you worry the most? Yeah, go ahead, Mike.
Yeah, I was going to say what we're looking for is where are the new stresses going to emerge? So those names are already trading in some of those sectors quite wide. If you exclude them from the high yield bond market spreads, for example, you can generally speaking subtract 30 or 40 basis points off of the OAS of the benchmark if you want to. And so it's priced in largely, I think, in that sector already, but new sectors that we're getting, I think, concerns about or looking for concerns about are things that are generally speaking consumer driven, because as obviously all the data is showing, inflation is still running pretty hot. The lower end consumer is eventually going to have problems where they're not going to be able to continue to spend at the levels they have. And so we're looking for more stresses in those types of sectors right now.
Now, the consumer point is a great one. I think, Andrea, a lot of people have a lot of concerns about anything that is consumer sensitive, particularly to lower and middle income consumers. How big of a ripple effect is there here in that consumer sentiment weakening, as you saw from the University of Michigan data today? Where do you think those concerns will start to ripple into credit markets?
Well, I definitely think it's the probably top priority to be watching the consumer. Now, what we're watching very closely is that unemployment rate. As we've already seen it tick up a bit, if we start to see it grind closer to 4.2%, that's really going to hit more than just the middle to low income consumer. But they are not the individuals driving consumer spending in the US economy. It tends to be the top of that income distribution. Once you start to approach that 4.2% unemployment rate, it's expected to start to see those upper income consumers change their spending profiles, grow more concerned about their own job outlooks. And that might be the catalyst to start to see high yield leveraged loan markets really begin to underperform, as we believe that bid is going to go very quickly back towards the traditional safe haven of more duration, higher quality. And that tends to be the portfolio that works as you are this phase of end of cycle.
Now, what do you think, Mike, is the best opportunity out there? You're putting new money to work tomorrow. Where do you put it?
Yeah, right now, I think where we're putting new money to work is in a mixture of two things. On the high yield bond side, we're continuing to favor shorter duration yield to call or yield to event types of bonds, because we're not trying to introduce new risk into portfolios. To Andrea's point, just a second ago, that the economy could roll over, and I think some of those sectors could be disadvantageously underperforming, so to speak. On the leveraged loan side, we are specifically up in quality, and I mean up in quality in terms of the higher single B portion of the market. We are avoiding, generally speaking, adding new risk to the portfolio in distressed and discounted names. There aren't that many discounted names really in the loan market right now at all. But overall, we're sort of, I think, more or less positioning up in quality in that sector and in businesses and in sectors that are really stable and industrials, chemicals, some of those sectors are where we're finding just better opportunities overall than away from consumer, media, telecom, those things.
Andrea, about 30 seconds left here. Favorite trade?
Sure. I think the sweet spot right now, given the current backdrop, is really that BBB to BB space across investment grade and high yield markets. Mike just hit the nail on the head thinking about where to be positioned in the leveraged loan market. We also like up in quality, but we would begin to pare back some of our floating rate exposure in our portfolios in favor for more duration sensitive exposure. But I think in the BBB space, you're able to find some bonds trading at discounts where you have that convexity at your favor should we start pricing in more cuts from here.
Andrea, DiCenso, and Mike Best, we thank you both for your time. Of course, a complicated time in markets, but that is, of course, what makes a market. Still ahead, the final spread, the week ahead. It's a big week ahead. A host of Fed speak in the pipeline. We'll talk about all about it next. This is Real Yield on Bloomberg. I'm Sonali, Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. As we've been saying, it's been a busy week ahead of us right now. We have Philadelphia Fed President Patrick Harker kicking off a busy week of Fed speak. And of course, some critical economic data still ahead. U.S. investors are looking to retail sales for clues on the health of the consumer by Tuesday. Wednesday, of course, markets are closed for Juneteenth. And Thursday, more central bank decisions from the SNB, BOE, and Nordjys Bank. And finally, Friday, global manufacturing PMIs and an S&P 500 rebalancing. And the final thought on all that Fed speak set for next week, we have Patrick Harker, as we've been talking about, Susan Collins, and many others throughout the entire week. We've been talking about it with our guests. It's that divergence that many will be looking for here on just how they feel about the future of this economy over the next year as they look to make that first rate cut, if not a second, as the market would also like. From New York, that does it from us this week. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.